Market update from me on a Monday morning, and very difficult to predict what the market's going to do. Obviously, last week was extremely volatile. What are we going to see this week? I'd like to see it settle down, of course, but nobody can predict the short term of the market. So what am I saying? Okay, so coronavirus has obviously affected companies, it's affected production, and therefore the markets have reacted not to the virus itself, of course, but the slowdown in global trade. So lots of companies are doing various things, stopping people traveling. Trade has stopped in so much as manufacturing has stopped in China, and we're seeing this concern of the unknown. Social media, of course, has had a big effect as well. So let's not forget that. Governments are making decisions based on they're worried about being criticized on social media, and so are companies. They're going, right, we've got to be seen to be doing the right thing. Has that led to an overreaction to a virus which at the end of the day is bad flu? Okay, well, you can say it can mutate into something else. It could go everywhere. Okay, well, yes, all of those things are true. Let's, however, look at the facts. Let's look at where we are. Certainly, China had a slowdown, but now we're seeing people returning to work. And in fact, talking to my guys in China, they're telling me that temperatures are taken twice on the way into offices and things are returning slowly to normal. Normal will be perhaps 3 or 4 weeks away. Why is that? Okay, well, teachers have been told they got 3 weeks notice before they return to schools. And even then, when they come back to China, they will go into quarantine for a period of time. So China's being ultra careful, despite the fact that the economy is perhaps teetering. Okay, of course, that concerns people. The world's interconnected. China is 17% of the world economy. Of course, it's stopping, even for a short period of time, has an effect. And of course, it's a concern that it affects countries that are more vulnerable. In other words, countries that were struggling near recession anyway are more affected by this downturn from China or stop of production, and it affects Germany, Italy, etc. in Europe. And of course, that has a continuing effect on the emerging markets as well. Obviously, are vulnerable to the effects of a massive slowdown in China. Okay, so, you know, I'm a financial advisor, so what should you be doing? Okay, well, I think that you can't tell where the bottom of the market is. There's value at the moment, and you've seen the markets grow down by 13%. Since World War II, there's been 26 occasions when the market has had a correction and gone down by an average of 13.5%. So what we're seeing is a normal correction at the moment, and when those 26 occasions have occurred and those corrections have occurred, then the average return to the previous value is 4 months. Okay, so you kind of go, wow, I could actually make some money in the next 4 months if you want to look at it. However, there is still downside. Downside is perhaps political. So, you know, China's concerned. Does it affect the infrastructure of their society? Do people turn against their governments? Do people start criticizing? You know, same thing even in America, where Trump could be accused of not taking enough action, and a downturn in the stock markets and a downturn in the economy, Trump perhaps would be blamed with an election year coming up. So is there more downside to the market? Potentially, yes. Okay, however, let's look at the positive. The positive is at some stage, governments will reduce interest rates. They'll put more liquidity into the markets. And when they do that, again, it's likely that stock will start to go up. Okay, so let's not forget where we were before the markets reacted to coronavirus. We were in a world where there was low interest rates and people were looking for dividend, they were looking for yield. The only place there was yield was in shares. Okay, we're now in a world where it's going to be more extreme. Yes, you've got companies that are going to slow down, perhaps only temporary, and the yield is even going to go lower from governments. So actually makes stock, particularly ones that pay good dividends, more valuable. Okay, and yet they've come down in price. So, okay, this is my view on it. Always difficult on a video because, it's online and everybody can see it for years to come. But my prediction is that you're going to see a rotation to quality. Okay, in other words, people will come out of stock that are a little bit like that. Lots of fingers crossed and arms crossed even, and the legs are crossed. They're going to move out of countries or emerging markets, particularly where, people are hoping for growth, and they're going to move to quality companies that are going to be around for a long period of time. Okay, so what should you do as an individual? Well, DeVere, we've always said that you should diversify your investments. So most of our clients will know we talk about multi-asset funds, which of course will have had a massive buffer because of their diversification compared with the markets over the last few weeks. So I continue to go with that, and I don't think that people should be selling. In fact, I'd actually go, selling's the worst thing you should do. It's actually a time to be investing money. Okay, look at it differently. I forget where the markets are today, where they're going to be in 3-5 years time. Okay, you can go, wow, they could go lower. Well, they could go lower, you're right. And they could all of a sudden increase very, very rapidly. So where are the markets going to be 3-5 years down the road? Okay, well, if you're in quality funds and in quality stock, then 3-5 years down the road, you're going to be making money. So don't try and pick the bottom of the market. Invest money in. If you want to drip feed it into the market, drip feed your money into the market and invest into quality funds. So a DeVere advisor or your own personal advisor can give you the information on what they believe are the right investments to hold at the moment. But I certainly wouldn't be running for the exit. Okay, in fact, I'd be doing exactly the reverse, trying to make sure that any cash, any excess that I've got was going into the markets. Okay, DeVere, we have advisors all around the world, and we also have an awesome app called Catalyst. So if you go to the App Store, UK App Store, you can get Catalyst and you can invest money via debit card, credit card, 0.75 per annum, low cost, super app. And you got a choice of 3 funds in there. And one is a liquid diversified fund, which is responsible investing. Okay, and that looks for just a steady return. And it is an alternative to the market because you're investing into things that are non-correlated to the market. So water, clean energy, fish farming, and that fund has actually performed well this year in spite of what the markets have done. Okay, DeVere Equity is another fund in there, high dividend, exactly what I'm talking about. Perfect fund for this particular situation, whereby you can have Guinness manage your money and they're invested in quality companies that pay high dividends. Okay, again, that offers protection and long-term offers some great returns. So gets Catalyst, you can invest as little as $50, £50, 50 euros, and that is one way of getting yourself into the market. Okay, if you want advice, you're more than welcome to link up with me, Instagram, Nigel.Green, Twitter, Nigel J. Green, LinkedIn. Okay, I'm certainly active on there, and of course on YouTube. So happy to try and give advice, but my advice is don't look at the short term. Yes, the markets are where they are, but there's actually value there, and I believe 100% between 3 to 5 years, you'd be glad you invested in the market right now. Okay, have yourself a great day. We'll watch with interest, and I'll try and keep you updated as best I can as I travel and as I work in the financial markets. Have a great day. Have a great week.